So let me tell you a little bit about Causeway. Causeway manages currently about $38 billion. We started with 0 in 2001, which was interesting because we had 24 people and no clients. So it was risky. But today I wanted to talk to you about, we have multiple strategies. We made it, we got through the worst trial any manager should ever endure, the 2008 global financial crisis. Our strategies are all thriving, clients love us, we're doing everything possible now to slow sales a bit so that we don't implode. The key, if you're a firm run by portfolio manager talent, is that you don't grow too fast. It may sound wonderful, except the problem is performance is the top of the food chain, and if you blow that, your clients all leave. Getting through 2008, however, was something really hard. It was I call it the horror show of money managers. And it taught my team and me a few lessons, and I thought today I would bring them to you because you're probably quite young. You might not have paid a whole lot of attention to the financial crisis. I just want to assure you, you'll see these in your career. Maybe not this one, but you will definitely encounter something like it. And these financial crises take what I call a serious bite out of performance. I just put a box, so you don't have to work too hard to figure this one out, around what happened. 2008, this is for international equity, which is our flagship strategy, was just a disaster. We performed roughly in line with a benchmark, but imagine losing half your clients' money in a year. They're not very happy about it. We were supposed to, as value managers, be defensive. We are the low beta, high dividend yield, buying those great companies. We were supposed to retain value in a crisis, and we just went right down with a benchmark with a beta of 1. And global equity was worse. Look at this. 2007 was awful because the US financials started unraveling at the end of that year. 2008, I just want to hide. But what you'll notice is 2009, big recovery. And one of the points I want to leave you today is, this is a litmus test question. Here it is. 2015, we Causeway go and make new presentations, pitches for clients, and they turn to me and they say, how did you do in 2008? And I just want to cry because it's a calendar year, it's not a full market cycle. And here we get to the first lesson of the global financial crisis. Pension fund clients, other institutions, any client for that matter, they look at risk asymmetrically. They're delighted to take it on the way up, but there's no way they want it on the way down, and they will literally forfeit performance in order to dampen their downside volatility. And this I never really understood until the financial crisis. Just get me consistent performance is what they're saying, which seems a little shocking since they all have gigantic liabilities, but as pension funds, that's the MO. Just to let you know, it's hard to tell from a stretch of calendar year numbers. Calendar year just being kind of an artificial time period. It could be February to February. It doesn't have to be December to December. But we've generated somewhere between 400 and 500 basis points per annum of alpha. So despite the financial crisis, that's alpha since inception, return in excess of the benchmark, we've done pretty well. And part of the reason why we had some excellent years post-2008 was because of what we did in 2008. We, in part, took it in the chin, but we also reconfigured portfolios. And that's in part what I wanted to take you through today is how did that work? I mean, our securities markets are always volatile. 2008 literally was a year to make or break a manager's reputation. So I talked about risk asymmetry. That was the first lesson that my team and I learned. And the other one was just don't be too dogmatic about value. As value managers, we get very uppity. It's an ethos. You're a value manager. You can't possibly be anything else. But if in a crisis you keep digging for deeper and deeper value, you've basically dug yourself into a hole. The most undervalued stocks are often a disaster, or they're on the cusp of being one. And that's something else we learned. It might have been wiser for us at the time, and when in the period leading up to the global financial crisis, when stocks got very expensive, remember we were in a credit-induced bubble, to have backed away from our strict value criteria and put a little more defensiveness in the portfolio. So I'll start with 2006. So 2006 was interestingly a lot like 2015, at least when it comes to valuation. There just wasn't anything to buy. So if you're in the halls of Causeway today and here in Los Angeles, you hear this moaning and griping by analysts because it's really hard to find anything that has any upside. At least from our perspective, we use very conservative assumptions. So 2006 was tough. By the end of the year, the return expectation we had for both our international and our global equity portfolios had diminished to low to mid-single digits, annualized. And at the time, relative to bond yields, that was not very attractive. Today, we have the same problem because equity markets are so long in the tooth that the return expectation for the stocks in our portfolio, and we think we've got a sort of much better portfolio than the benchmark, is quite low, but bond yields are vapor today. So this is a different environment, and yet it's oddly similar. We moved into 2007, and then we saw, I call it the preludes, signs of crisis arising. This one was fascinating. The mid to small cap stocks traded valuation premiums to their large cap peers. There's no reason for a small cap stock to trade at a valuation premium, unless it's got far superior growth. Usually small cap stocks are lesser liquid. They should trade at a valuation discount because they're very difficult to trade. The reason why this anomaly occurred is because there was so much money floating around. The banks were lending hand over fist. M&A was on fire. Private equity firms were paying more than trade buyers. So private equity was able to, and did, simply pay higher valuations for mid to small cap companies. They were gobbling them up as fast as they could. So here we were early 07 looking for something to buy, and we bought Ericsson, the Swedish telecommunications hardware company. They'd reported 3 prior quarters of disappointing earnings, and we figured with the increase of mobile telephony penetration, especially in the emerging world, they'd start seeing more orders. Well, they were kind of endemic of a shortage of undervalued stocks in our investable universe. We had switched our emphasis to laggards, and that was one of them. But what we failed to notice was that the competitive environment was worsening, and Chinese competition was eating Ericsson's lunch and continued to do that. So here was a weak stock to begin with going into a crisis, which is not where you want to be. By July of that year, investment bank Bear Stearns had liquidated 2 of their hedge funds that invested in derivatives backed by subprime mortgages. The signs were coming. I think I was on a beach somewhere into July and kind of rolled over. I should have gone right back to the office. We had Countrywide Financial, their credit rating cut massively by Fink. And there we were still buying late bull market stocks, undervalued, and supposedly with great financial strength, which is one of our screening criteria. Well, another example of a stock we bought was a Canadian company called Precision Drilling, an oil rig operator trading at a 40% discount off their 52-week high. They're well above the Canadian market dividend yield, well above dividend yield in any market. Low valuation, a good prognosis for rig supply demand. Well, I'll tell you later just how awful that one was. We bought a Japanese condominium contractor called Haseko, specializing in Tokyo, where the supply-demand dynamics we thought were very favorable. The stock traded at 1/3 of the PE of the Japanese market. That was another, I might even have a chart on that one. We've renamed that stock Hasinko. And to the team, it's sort of funny but bittersweet. We bought one of Italy's largest banks, UniCredit, British Airways, which today is called IAG Group, Smurfit Kappa and Packaging. We bought companies that were cheap. They had high fixed costs, so they had a lot of operating leverage. Going into a financial crisis that brought about a recession, that was exactly where you didn't want to be. We had to be fully invested. You're all asking, why were you buying all these stocks? Couldn't you just sit on cash? Unless you manage some sort of exciting retail mutual fund and brokers are throwing roses at your feet, you have to be fully invested. Institutional investors demand it, and that means 95% plus. No matter the market environment, no matter how expensive stocks are or how cheap, you have to be fully invested. Otherwise, you're fired. They're not paying you to manage cash. So we had no idea how long this tired bull market that stretched in the first half of 2007 would last. We we picked up at the time in the second quarter of 2007, Sprint and Nextel. You already can tell how this is turning out, and not well. So they had a lagging third place market share, low valuation. We thought there'd be restructuring and upside. They'd sell off the Nextel business to boost returns. Well, by December of 2008, we'd sold that stock to zero because, and this is where I'm going to give you an example of what we call second order effects. Not only did their business not pan out as we expected, but it turned out the bulk of their mobile customers were lower income with jobs related to the construction industry. So here we have a wipeout of construction because the housing market collapses, and all of a sudden Sprint's customers can't meet their phone payments, and then the financial strength began to deteriorate on the stock, and we had to sell. So then back to June of 07. Now this is where you're going to think I'm nuts, because in retrospect it sounds perfectly irrational. We bought Countrywide Financial. I remember the discussion about this. It was cheap, it was trading half of book value, and we'd gone over and over again book value to make sure it was solid ground. We'd looked at their prospective loan losses, assumptions about defaults. We thought it was a takeover candidate. We were confident, and we were wrong. So 3 months later, their credit ratings get slashed. We sold that stock in August of 2007 to avoid an insolvency. I never even tell clients this. I think they would be, they would be sort of trembling. So all of our estimates of default loan losses were all wrong. And what we really didn't get was that the wholesale funding market, how banks and financial services firms fund each other and fund themselves, froze. That makes it a little tricky if you're a highly leveraged entity, which every financial services business is to one degree or another, especially banks. And then that Canadian driller, Precision Drilling Trust, rig demand collapsed as we moved into late 2007. And then at the time, into 2008, the company decided to make a major acquisition of a competitor, and they geared up. So they took out a lot of debt. We thought they were nuts. So why would you leverage up right into the face of a recession? So that one we had to get rid of. And then Hiseko, the condominium contractor in Japan. So they ended up, all their orders stopped. They decided to engage in a dilutive equity issuance. There were a lot of those happening at the time. And we were horrified, and we were contacting management trying to understand, because this is a company that didn't need to raise equity. They had plenty of access to bank capital, and the Japanese banks were lending to their brethren. So that was frustrating. And then September of 2007, our mutual fund clients started to redeem. And this is part of what was wrong with the financial crisis. It wasn't just that there were problems with underlying securities, there was a panic, and the panic fed on itself. So redemptions led investors to redeem more. And every time there was a redemption, you have to sell. And as you sell, you drive the price down, which leads to more panic and more redemptions. Yes, just thinking about that. And a point here to note is, in this type of crisis, my team had seen this in 1997 in the Asia financial crisis, valuation becomes irrelevant. You can sharpen your pencil, you can do all the analysis you like, it doesn't matter. Investors are when they sell indiscriminately, they sell first and ask questions later. It is truly what I would call a risk-off environment. The financials underperformed badly, and that's one of the reasons why 2007 was such a tough year for our global equity, because when you own we had a number of US financials, and they were particularly hard hit. We had the crisis in subprime mortgages infecting the credit markets, and then it all began to skyrocket. And by January of 2008, Bank of America, we'd already sold it. Bank of America bought Countrywide for $4 billion. It was a salvage operation. By March, the Federal Reserve was guaranteeing $30 billion of Bear Stearns assets in connection with the JP Morgan purchase of Bear Stearns. And then the first half of 2008, our clients were watching as we underperformed because we didn't own what was popular. It was commodities. Remember, oil was at $140 a barrel Brent. By the end of 2008, it was $40 a barrel Brent. The first half of 2008 was emerging market related stocks. Those were popular commodities. There was a lot of excitement about growth outside the US and the developing world. So we bought Japanese chemical companies, and we bought a Norwegian shipper, and we bought whatever we could find. I mean, stocks were still expensive. And we bought Royal Bank of Scotland. That turned out to be an absolute disaster. AIB, Allied Irish Bank, they don't even exist any longer. They were such a disaster. Neither does HBOS, which was a UK bank bought by Lloyd's later on in another salvage operation, and UBS. Now you're just wondering, how are we in business today? Well, you know, that's an excellent question. Wait, it gets worse. So we also bought Fannie Mae, Freddie Mac, who were both then, they'd been in the portfolio since 2005. And we liked this idea that it kind of got the benefit of government sponsorship without government ownership. Unfortunately, they ended up being taken over by the government and in conservatorship, so those were out of our portfolio. We heard more and more management say to us, we have enough capital, we have access to financing. They went on internet, global television. I mean, CNBC, Bubble Vision, broadcast all over the world. These were bank CEOs saying, we have adequate financing, we can finance our business. The next day they were bust. AIG accepted $85 billion federal bailout, and the government ended up owning almost an 80% stake. Washington Mutual was closed by federal regulators, and their branches sold to JP Morgan Chase in the biggest banking failure in US history. I mean, this was bad. Late September, you know, the then Treasury Secretary Paulson was talking about the U.S. on the precipice of financial disaster. I mean, we were in it already, as far as I could tell. So our buying then changed. We recognized we had too much cyclicality, but there was nothing we could do about it. Those were the cheap stocks. The stocks that did well in the latter half of '08, that created performance far better than ours in that calendar year, were consumer staples, utilities, healthcare. And curiously, those have been the same stocks in the last 2 years that are outperforming in almost every index globally, especially in the emerging markets. There's a certain amount of fear trade in markets currently. Oh, right, I guess I left this so long it thinks I've died too, along with the presentation. Well, anyway, I'm going to show you, if I can make it rev up again, a couple of the charts on, well, yeah. Oh yeah, that would be wonderful. I'll just keep talking. I have to show you the chart on Fannie Mae, because it goes like this, it kind of falls, and then it just looks like someone on a table had a heart attack, it couldn't be revived. Yeah, just nothing you couldn't have guessed. I just thought it was visually sort of endemic. By late September of 2008, here we were holding cyclicals, the defensive, economically defensive stocks were performing better, and clients were getting very upset. Lehman goes bankrupt. The Japanese called this the Lehman Shoku, and that's their reference to the whole period, but it was very much a shock. There was no commercial paper issuances. Companies couldn't fund themselves. The credit markets were frozen. Absolutely extraordinary. So our job as portfolio manager was now to ensure we not only held cyclicals, we had to by this time. We'd already dug our grave. We owned cyclical stocks and to keep owning them. So you can't all of a sudden dump your portfolio and buy expensive or relatively expensive healthcare and utilities and staples. You've got to stick with the plan you set out. But we upgraded it. And so instead of, oh, you did it. Excellent, thanks. Perfect. Instead of owning cyclical stocks that were financially, whoops, here we go, financially weak, we own those that were financially extraordinary. So our team made the decision, we had to find companies with net cash on the balance sheet that had so much in the way of financial wherewithal they could fund their customers, their suppliers, their whole chain. Can you imagine? I mean, this was a time when no credit was available. And by September of 2008, Congress had rejected the $700 billion Troubled Asset Relief Program. You remember TARP. That sent stocks plunging, and the Dow had its biggest point drop ever. And then in October, Congress passed a revised version of TARP. Wells Fargo bought Wachovia. By November, Citigroup was guaranteed by the government and got funding and access to capital. And by December, the U.S. Treasury authorized loans up to over $13 billion to GM and $4 billion to Chrysler from TARP, which was quite controversial at the time. So defensives or cyclicals were still doing badly. We finished the year and we slunk into client meetings, hoping no one would recognize us. By the end of 2008, to fund the purchase of these extremely well-capitalized cyclical stocks, recognizing the cycle had to turn at some point in time, we sold a French lodging company, Accor, very defensive stock. We sold Publicis, another an advertising business, also French. Takeda, Japanese healthcare, predominantly pharmaceuticals company. Compass Group, UK, in catering. Tate & Lyle in food ingredients. These were all defensive stocks. They weren't expensive, nothing was, but they were the source of funding to plow into cyclical stocks. And then 2009 comes along. So by late February, we were buying, we think, the greatest companies that any of us will ever see in our investment careers. Every single stock we follow, we put a 2-year price target on, we know the income, so we have calculated a total return. And if you weight each one of those stocks by their weight in the portfolio, we can then aggregate into a portfolio expected return. Those returns are, over time, have been somewhere around 9 or 10% for our portfolios since inception. The expected return on our portfolio in late February of 2009 was 49% annualized. So we had reasons to take risk. We had been backing away from risk in 2006. By the end of 2009, we were buying high beta stocks. We were looking for life insurers. We're adding anything that would add market exposure with financial strength to the portfolio. The point I want to leave with you, just so that you walk out of here and say, wow, yeah, they did a lot of risky things. When markets are on their knees, when bear markets savage equities, that's when risk is the lowest. It's not when risk is the highest, and 95% plus of my clients think the opposite. They think after a long period, a bull market, the risk is low because equities have gone up, and clearly they're low risk now. It's the 180-degree difference. Right now, equities are risky and expensive, and we as a team are taking risk down. So we found by the end of February of 2009, it was as if we'd been invited to some giant equity smorgasbord. I mean, it's like, eat all you want. And everything was on sale and sort of free. We bought, and this is a company that's in the news today, Fanuc, an industrial engineering firm. They make robots, so the world's best. This is a stock we'd followed and wanted to buy for 15 years. We just waited and waited and waited, and there was an opportunity. Net cash on the balance sheet. They have so much cash that today they're being, I'd say, agitated by a activist investor, Third Point Capital, to do something with that cash as in return it to shareholders. And I would put very high probability on nothing happening. We bought Disney, we bought Cisco, we bought Oracle, we bought a Swiss luxury watch and jewelry maker called Richemont. Again, we've wanted to own that for probably 20 years. And we bought all we wanted. We just loaded up the truck because nobody else did. Those are the stocks that paid off. And that's when I showed you that performance page. 2009 was a great year. 2010, 11, 12, those stocks continued to deliver. We didn't have to sell them. They just continued to add value to the portfolio. So here, we'll just walk through a few of these. Yeah, this one is Haseko, awful. I don't even want to look at this. Precision drilling, we bought this right about I'm showing you June of 2007 to give you an idea of, supposedly it was a fair weather time. The stocks were expensive. We thought this one had underperformed. It was interesting. And that line goes down and it never recovers. UniCredit, this Italian bank, again, didn't recover. We had to sell this in about January of 2009 because we were certain they'd have to raise a lot more capital and then we'd just be diluted away. Yeah, here's the sad one. Good old Fannie Mae. Yeah, well, I actually knew one portfolio manager, a friend of mine in New York, who just kept holding the stock, and I thought, well, I don't know how long your time frame is, but mine isn't, not even close. Our clients give us 3 years from when we're hired, and they'll evaluate us every quarter, in some cases every month. In this crisis period, it was every week. But if your stocks aren't delivering after 3 years, you might as well just pack it up and go home, because that's all there is. And interestingly, as an epilogue to the financial crisis, time frames, sort of the patience that clients have has shrunk. So nobody really learned anything from this except that they're more impatient. They'd rather not be in the pension department. They want to go somewhere else, and don't embarrass me. And so the whole market, with an advent of increasing amount of hedge funds, has become very short-term in nature. This is somewhat useful for us because if we look out 2 years, we're considered to be an eternity investor, not just long-term, in an environment where 3 to 6 months for many is their average holding period. So in the wake of this whole financial crisis, we took our quant group, we're a fusion of fundamental quant research, and we made them much more important in our organization. We have combined fundamental and quantitative portfolio manager meetings. We not only have a standard multi-factor risk model to measure the marginal contribution to risk, defined as volatility of every stock in our portfolio and every stock we're contemplating adding to the portfolio, but we also have an extreme risk model we designed in the wake of this horrendous period to ensure that we know in market downdrafts, so in the absolute worst environments of both the international and the global index back 8 years, how would our stocks have performed? Which are the culprits? Which ones, the top 10 that are going to be badly behaving if history is any judge of the future? And what are the bottom 10? Which ones can we consider ballast that will hold the portfolio together? And the more risk averse we become, the more stretched stock markets are, the more emphasis we put on those ballast stocks, and the more discussion we have about the high risk stocks. If a stock is going to be adding volatility, it better be able to add enough return to compensate clients for taking that risk. And if it doesn't, we shouldn't hold it. So our whole discussion of risk became a much more pointed and focused. And lastly, I'd say beta is still a problem. We have to lower portfolio beta today because, again, clients, when you're looking at mid to low single-digit returns for equities at best, in an environment where bond yields are really pitifully low. So the equity risk premium is still there. It's just that the risk-free rate is now vapor. And think how low it is overseas. You may say, well, it's 2% in the US on the 10-year. Well, in Switzerland, it's slightly negative. Well, it's 0. In Germany, it's 37 basis points. In Japan, it's 35 basis points. If you invest globally, you have to be aware of all these bond yields, and they're indicating very, very slow economies ahead. So if we can't lower portfolio beta by just buying low beta stocks, because those are kind of expensive right now, they tend to be in the same culprit areas, consumer staples, utilities, healthcare, what do we do? Well, the only way to get around that problem is to diversify, but not by holding this proliferation of stocks. We can still have a fairly concentrated portfolio of 35 to 50 stocks in global and a few more in international, but they need to, in the context of a giant covariance matrix, they need to be sort of lowly correlated with each other. You can buy stocks in different regions, you can try to diversify by sector. That stuff is useless. You need to know statistically how your stocks behave relative to each other. Again, assuming the past has any bearing on the future, and then diversify and diversify and diversify until you're holding a portfolio that's likely to behave reasonably well in a downdraft. Because getting back to those performance charts I showed you, how did you do in 2008 will continue to be the question of the rest of my career, and there'll be something similar for yours. So who knows what the next financial crisis will bring, but I can assure you we will be ready for it. Great, well, you've been a terrific audience. Thank you.